Hello, this is Johanna Fox-Turner at Milestones Financial Planning, coming to you with our monthly newsletter video. In our newsletter this month, we've been talking about asset protection, and I've got a question for you. Is your retirement plan at risk? Okay, you've probably heard that stocks are risky and that you should gradually switch to bonds as you get older. But is that really true? Here's how we define risk at Milestones. Loss of purchasing power. You need to maintain and increase your purchasing power as you get older, not decrease it. It means that each dollar you hold in your pocket for the long term is going to be worth a little less every day. Now that may not sound like a lot from day to day, but how about over 30 years of retirement? Will Social Security be enough? That's a long time to live on just Social Security and a small certificate of deposit. Okay, so let's take a look at what I mean about inflation and how dangerous it is. I've talked with a lot of people who have money, lots of money in cash and CDs. They think it's safer and less risky that way. Here's what they don't see, because you can't see what you don't have. If you have $100,000 in a bank account just for a nest egg during retirement, after 30 years at 3% inflation, it's going to be worth only $40,000 and change. And we have no guarantee that inflation is going to remain at 3%. If it goes up to 5%, you're going to have just a little over 20% of what it was worth in the beginning. Now you say, okay, I don't want to spend that money. It's a nest egg. I want to pass it along to my children. Well, is that really what you want to do when you could have given them a lot more money? Here's a chart I prepared for a client recently. She put $200,000 into a certificate of deposit a year ago. This chart shows the results of putting that $200,000 into a 1% CD versus investing in our standard model portfolio for the year 2012. Here's the $2,000 she earned. Here's what she could have had. $13,600 in dividends, $33,480 in growth, and then we would have taken a fee of just under $2,500 for managing her account. So even if the market had stayed flat, you say, we wouldn't have had that growth. Yes, but you would still have had dividends, right? I want to point out that 2012 is only 1 year, and we do invest for the long term. In the long term, you can expect the market to drop an average of 14% at least once every year. Every 1 year in 5 is going to bring a bear market, and that means there's going to be an average drop of 1/3 of the value of the stock market. But for a long-term investor, that really doesn't matter. What you would still have, even if the market had dropped, is $13,600 in dividends versus $2,000 in interest income from a CD. If the market had stayed flat, you would still have your dividends as long as you don't need to take your money out. You're going to get $13,600 less our fee, or $2,000 in dividends. What makes more sense? To pay us a fee of a little over $2,000 and get $13,600 in dividends and growth over the long term, or to earn $2,000 in interest? But you may be thinking, what if we had a bear market in 2012? What then? We'll go over what then in our next video. In the meantime, if you have a question about whether you have risk in your retirement plan, call or email us for a free initial consultation. Thanks for listening, and until next time, cheers.